Hello and welcome to Value Research Podcast. You're listening to First Page, a column written by Dhirendra Kumar. The profit of bubbles and the power of process. Following market predictions, even accurate ones, matters less than having a sound investment strategy. Do you remember the late 1990s? What a crazy time in the equity markets in India and globally. Tech stocks seemed to mint new billionaires weekly, and the prevailing wisdom was that traditional market metrics no longer mattered. Any number of companies were pretending to be tech, a trick still being played on investors. This time it's different, almost everyone said, as the indices soared to new highs daily. But one economist, Robert Shiller of Yale, saw through the mania. His research had revealed something that should never have been forgotten. Markets aren't driven purely by logic, but by the stories we tell and believe. When these narratives become divorced from reality, bubbles form. History vindicated Shiller spectacularly. The subsequent dot-com crash wiped out $5 trillion in wealth, with the Nasdaq losing 78% of its value by October 2002. In India, the Sensex fell by 56% at the time. But Shiller wasn't done. In 2005, he warned of a housing bubble, only to be dismissed again by those who insisted that housing prices never declined nationally. We all know how that ended. The 2008 crash destroyed vast amounts of wealth around the world. This visionary work on market psychology earned Shiller the 2013 Nobel Prize. Now, Shiller's warning bells are ringing again. He sees troubling patterns in today's markets. Mass psychology mirroring past bubbles, historically high valuations, and, particularly, AI is warping market psychology much like the internet did in 2000. His famous CAPE ratio for the S&P 500 has reached levels seen only during the dot-com bubble. Shiller's innovative way of valuing markets is the CAPE ratio, or cyclically adjusted price-to-earnings ratio. Unlike the standard PE ratio, it compares current market prices to average earnings over the past decade adjusted for inflation. This smooths out short-term fluctuations and gives a better picture of whether markets are truly overvalued. When this ratio reaches extreme levels, it often signals that investor optimism has outpaced economic reality. But here's where we need to pause and reflect. The real value of Shiller's work isn't in his specific predictions, which are as remarkable as they've been. It's in his fundamental insight about markets. They are driven by human psychology, our hopes, fears, and cognitive biases. Markets are, in his framework, predictably unpredictable. This brings us to a central point. The most successful investors don't try to predict crashes or time markets perfectly. They are the ones who build robust processes that work across market conditions. They understand that while Shiller might be right about bubbles forming, trying to time their burst is pointless. So think about this. Even if you had believed Shiller's warnings in the late 1990s, when exactly should you have exited the market? It's too early and you would have missed substantial gains. It's too late and you would have caught the crash anyway. The same applies to his housing market warnings. Being right about the bubble didn't necessarily translate into actionable investment decisions. The real lesson here is about something other than following predictions, even those from Nobel laureates. It's about building investment processes that acknowledge market irrationality as a feature, not a bug. This means regular, systematic investing, diversification, and, most importantly, the emotional discipline to stick to your strategy when everyone else is either euphoric or panicking. In today's market, AI has renewed the hype in a manner that reminds me strongly of the late 1990s. Certainly, Shiller's warnings deserve attention. But rather than trying to time the market based on these warnings, it would be much better for us to focus on strengthening our investment process. Are your allocations aligned with your goals? Can you stick with your investment strategy through both bubbles and crashes? Markets will always be driven by the stories we tell ourselves and those we hear and believe. The key isn't to predict which stories will prevail, but to build an investment approach that can weather any narrative. Trust your process over predictions. It's the one story that's likely to have a happy ending.